massive. I mean, it's material in the sense that we generally see, a multi-hundred-billion-dollar annualized new tariff revenue. But when that's got like a two handle on it, so when we're talking about 200 billion in new revenue, that's pretty small relative to like 2 trillion in deficits. If you kind
Yeah.
of round it and say the government spends 7 trillion a year and takes in 5 trillion, if you add 200 billion, it's not that it's immaterial, but it's not really a game changer. The latest round of tariff letters that have gone out,
Hmm.
if they were all to be believed and enacted and then sustained, that would be something more like an $800 billion
Right.
tariff revenue stream, which I would argue would be very material. Um, and so I think that still is a market risk. And one thing I'm kind of observing is that back in the April kind of earlier round of tariffs, there were market events, and generally speaking, you had a backing off from the administration, delaying some of these things.
Hmm.
Now we're seeing that kind of the second round of tariffs potentially go in. The market seems to be trying to see through it and say, well, probably these will get pushed back or negotiated, or this is kind of a strong opening volley. This could be considered a trial balloon. Basically, they put out a lot of headlines from directly from the White House and officials saying that they were maybe going to do this. Poly market odds spiked to something like 35%. At the same time, there was a pretty rapid, not a very large one, but a pretty rapid drop in the dollar index.
Hmm.
And there was a drop in stocks and the long end of the treasury curve, meaning that yields went up. That's generally not a successful trial balloon. If they had announced this news and the dollar was firm and yields went down, which is kind of what they want, then they might have, it's possible they would have gone through with the attempt. But because the trial balloon was basically saying that you kind of get the emerging market effect on your assets if you do this, it could have affected their decision. Hard to say either way what the counterfactual would have been.
Right.
Um, there's also legal questions. I mean, do they want that legal fight? Because the chairman can be removed with cause, and whenever you have a legal term like with cause, that's going to be debated if there was cause. So that
Hmm.
could be a protracted fight that could be distracting from other things. So my base case is they won't remove him, but as headlines have kind of shown, it's certainly a possibility. The market's already shown what it thinks of it whenever these headlines flare up. It's high quality equities, that's gold, that's Bitcoin, certain real estate that's not overpriced. And generally, you also want to find entities that can short the currency. I mean, part
Hmm.
of what makes corporate equities attractive is they've issued like 20-year bonds at 2 or 3%. So they're basically right along with you, shorting the currency and then owning better assets. Same thing for some of these Bitcoin companies like MicroStrategy that have taken out like zero coupon convertibles,
Hmm.
buy Bitcoin with it, and have like 5-year durations on it to give them a lot of runway. So those is much lower volatility. It's about 10 times larger of a market based on most estimates. If you look at like the World Gold Council, now we
Hmm.
can audit the full supply of Bitcoin and know it down to the decimal point. We can't audit the full supply of gold, so we have to rely on estimates. But generally speaking, gold's about 10 times bigger. Obviously, has a much longer track record. Where I would say that Bitcoin somewhat competes with is other precious metals exposures, generally the higher volatility ones. So historically, if someone was bullish on precious metals,
Hmm.
gold would be like the lower volatility one you might never sell. Whereas like silver, platinum, gold miners, these types of ones were generally considered more volatile plays on that trend. I'd say to some extent they do compete with Bitcoin and maybe to some extent broader crypto, which is you have these more volatile non-fiat currency assets that now kind of fractures the liquidity to some
Hmm.
extent. We're buying that it's not really an investable trade because like unless you're the issuer, because stable coins are pegged to a dollar, but they have market implications globally. One way to think about it is that for decades, wealthy people had access to offshore bank accounts, and this is relevant in a world of 180 different currencies, most of which debase very quickly, and pegs break, and inflation happens, and authoritarian governments can seize assets. So all these kind of wealthy entities could have offshore bank accounts, and stablecoins are basically offshore bank accounts for the middle and working class. It
Right.
uses technology to compress the overhead, and it makes it easier to access custodial dollars and also use them as basically a checking account in dollars for those that don't have access to American banks or other developed market banks like Europe, Canada, these types of places. And so, across, Africa has 40 plus currencies. Imagine all the cross border frictions of trying to trade. Latin America has something like 30 plus currencies. Again, all the cross border frictions. Most of the currencies and move the needle, but it's not like a necessarily a game changer in and of itself.
Right. Yeah. I mean, we're seeing it in front of the House right now. I mean, they stalled the Genius Act last week despite the bipartisan momentum. But I think it was Marjorie Taylor Greene. She called it a CBDC Trojan horse in a viral tweet. I mean, President Trump tweeted from the Oval Office last night that 11 House Republicans had agreed to move it forward. Is this the turning point for stablecoin legislation, or a warning sign that kind of CBDC style frameworks could emerge through the back door?
So I think we'll see how this plays out. I mean, one
Right.
notable thing about the Genius Act is it prevents stablecoins from paying yield,
Mhm.
which makes it harder for them to compete with onshore banks, which is interesting. Stablecoins in general can kind of serve as a private sector CBDC. So instead of the government doing it themselves, they can just say, well, this other entity can do it, but then we of course have control over that entity. We can always, if we don't like how they're doing it, or they're not conforming to the regulations we've given, we could sanction them. We can effectively cut them off from the dollar and the treasury network,
Mm.
and otherwise make it very difficult for them to do business. And so with that, they get surveillance that is built on top of Bitcoin. That basically resurrects 40-year-old privacy technology that used to be developed for fiat, didn't really take off, and you can actually it's actually much better on an open source foundation like Bitcoin. So there are long-term privacy solutions here. But basically, Bitcoin is the one that's not just kind of instantly freezable,
Yeah.
whereas stablecoins, just like a bank account, in many ways are.
Yeah, it's incredibly private. I mean, I'm thinking about these billions of dollars worth of Bitcoin right now waking up from these old wallets and kind of coming to power. No one knows who they're from. No one knows what's happening. It kind of goes to the case thesis of Bitcoin, if I'm right.
Yeah, I think so. Bitcoin itself is anonymous in the sense
Yeah.
that if you acquire Bitcoin and then send Bitcoin, there's nothing that links it to you. Now, because a lot of exchanges and brokers are KYC'd, they're semi-effective at tracing Bitcoin. But
Mhm.
especially as Bitcoin, if you look at the long arc of time, as Bitcoin circulates more, and if more merchants directly accept it for payment, all those payments become much harder to track. So in an environment where
Mhm.
um, on the other hand, there are other networks that optimize more for scalability. And so Ethereum kind of finds itself in the middle ground of trying to justify itself as a long-term holding while also trying to compete with some of these faster networks that care even less about decentralization, and try to just make fees and other things as low as possible. And so I think it's best to stick to the best in class one, which is Bitcoin. I think that's the one that's institutionally sufficient to put in major corporations and build ETFs around. But that doesn't mean that others won't have their time in the sun temporarily. I just think that long term, I'm not particularly bullish on the ETH BTC ratio.
Okay, interesting. I mean, somebody had to do it, as you said, right? First to market. I know earlier this month you told precious metals investors that they could buy 5% Bitcoin and go to the beach. I just got to ask, I mean, again, with the Kitco audience in mind, why that specific number, and how should gold investors think about the Bitcoin allocation without a
Gold. It's got self-reinforcing network effects. You can send it to people very easily. Like if you were to hold a QR code up on this call, I could give you Bitcoin. I can't give you gold in any sort of
Mhm.
direct way without credit. And so they're two different asset classes or two different assets that kind of compete for similar but not identical markets. And I think they're both valuable.
Yeah, and it's not too late to get in here at 120,000. I mean, do you got a price a little bit of an overview for us, an outlook?
So I don't have a near-term price target. I don't think that this cycle is over yet. So I
Okay.
think we're going higher this cycle. I don't know if that means 150,000. I don't know if that means 200,000. I wouldn't try to guess.
Yeah.
At any given time, I'll assess market conditions, levels of
They need to understand now before the next phase begins.
probably the big. I mean, the biggest macro thing I follow is the structural U.S. fiscal deficits and how
Right.
intractable they are, and the fact that the current system designed such that total credit can't really stop growing for
Hmm.
anything more than like a year before things really start breaking. Uh, and so, with that backdrop in mind, that's the investing backdrop you're working with. I would
Yeah.
say, in the more cyclical sense, for me, by far the biggest headline to monitor is tariffs, and the reason for that is part of the large fiscal deficits, part of not the only reason, but part of why they're so hard to reduce, is that there's a lot of congressional polarization around either cutting major areas of spending, so Social Security, Medicare, defense, veterans benefits, interest expense, obviously very challenging. So, and that represents the vast majority of spending. So there's all these kind of things against spending cuts, and then there's also multiple defenses against tax increases. Most Republicans would not vote for significant tax increases, for example. And so when you have that combined, it's very hard to address the deficits.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.